Thanks for joining us for today's episode of The Capitalist Investor. As always, you got Mark and D.
Mark, what's up, man?
What's up, brother? All right, my man. So today we are going to be talking about, since it is January.
It is.
And it's only fitting that we do this. We're going to be talking about the January effect, which is basically what happens in January with regards to the stock market. Right, a lot of people say, as goes January, goes the year. You know, there's all kinds of different sayings, all kinds of different hypotheses surrounding January. And let's just kind of go through them and make some sense of all this stuff.
All right,
whether or not we buy into it, whether or not we believe it, some of the rumors that are floating around out there. Because we get hit with these kinds of questions from clients all the time. Right? Like, I've had clients say, well, it's an election year, so it should be a good year. I really don't pay attention to that kind of stuff, but okay, if you say so. So let's just kind of go through and let's look at calendar effects, market anomalies as a whole, and kind of narrow this down to talking about the January effect.
All right.
So the saying is, as goes January, goes the year. So basically, people tend to believe that if January's positive, then the rest of the year should be positive.
Right.
All right. I did a little homework, and it looks like the S&P since around 1950, up around 74% of the time. January, positive 62% of the time since 1950. So, hey, man, I'm no PhD in mathematics, but it doesn't sound like there's perfect correlation there to me.
No. And that's why I didn't actually realize until I was researching this. It is kind of a hotly contested issue.
Yeah.
It's why does it happen? What is really the cause of it?
Yeah.
And there's many theories out there. But basically what I saw is if you go back to 1950, if January goes up, then the year finishes positive 87% of the time.
Yep.
And there's been 9 major errors in there. So, it's that one looks better. But what you just said, what I see is between 1928 and 2018, that correlation is only 62% of the time. So,
not the correlation. Are you sure that's the correlation, or is that how many times January was positive?
That is the number times January was positive.
Yes,
yep.
Exactly. Okay. So, they move together 87% of the time. Right?
There you go.
Since 1950. But the market's up almost 87% of the time by itself. So, right? I mean, it's up like 75% if I shorten that time frame to maybe the last 20 years. Mm-hmm. I mean, how many negative years have we had from 2000 to 2020? Actually, it'd be like 2001 to 2020. Maybe 3 negative years?
Yeah,
4 negative years?
Probably 4. But I have it here. It's only been negative 17 out of the last 73 years.
Yeah.
So some of this.
So that's 20%.
Mm-hmm. So I think
80% of the time the market's up,
right.
right? So this January effect thing is like, I don't know, man. I don't know if I really buy into it. I kind of take it with a grain of salt. The other thing they talk about is why is the market always up in January? Mm-hmm. Well, first things first, dude. It's only up 62% of the time. But a lot of people are, they've got these different hypotheses, right? And some people believe that a lot of people, they sell their losers in December so they can take advantage of tax loss harvesting.
Right.
And then they rebuy them in January. And the money flowing back into stocks in January because of their tax loss harvesting, that's what helps to prop the stock market up. What I can tell you is that the market sold off the first day of January 2021 because investors did the exact opposite, right? They didn't want to sell their winners in December, so they waited until the tax year clock turned to 2021, and then they sold all their highly appreciated positions.
Right. And so that totally makes sense in theory.
Yep.
But that only works for non-qualified accounts.
Yeah.
So I don't know the numbers off the top of my head, but I would say most of the money in the market is probably in IRA accounts, qualified accounts.
I'd love to know the answer to that.
Yeah, I'll get going.
I would
on
love
that.
to know the answer to that. Is there more money in qualified accounts or non-qualified accounts? I wonder how we'd even figure that out. You raise a great point there. I wish we had the answer. Maybe someone can email us with the answer to that. info@swpconnect.com. Give us the answer.
But also but history is on kind of the January effect side, because what I found is January, average return for January is positive 1.8%, and the average for all the other months combined is only positive 0.7%.
What the heck time frame are you looking at?
That goes all the way back to the Great Depression, 1928.
All right, so this is funny. All right, so you use that time frame.
I think you're going to steal my question, I think.
I'm coming up with a different time frame. So I used a calculator that calculated monthly returns from 1950 through 2020.
Okay.
It's amazing how we just moved the goalpost from, you're probably using 1928, I'm using 1950. Completely random, right? So, but from 1950 through 2020, the best performing month is April. Second best performing month is November. Third best month is December. I haven't said January yet. Fourth best is July.
Wow.
Fifth best, January at like positive 0.97%. It's the fifth best performing month, yet people are so hung up on this January effect. Why is January so great? In actuality, from my perspective, January just happens to be part of a great stretch. If you think about it, the market is seasonally strong from November through May. There's that saying, sell in May, go away. Right? The market is very sleepy in the summertime. May's barely positive. June, July, and August, they're probably all negative. September and October are pretty weak or lackluster. And then you get into the big months. You get November, December, January, February, March, April. Those are the big months. I wish I had that math in front of me, but man, I would bet that 70 to 80% of the market's returns, maybe even higher than 80, come over the course of those months that I just mentioned. Right?
Because I was thinking about this, because how much weight do you think we should put into trends that happened in the stock market before World War II?
None. How much weight should we put into trends that happened before an internet existed?
That would be my point. Should we even really be looking at anything before 2000 if we're trying to identify trends?
Right. No, I don't think so. I think you kind of start at 2000 nowadays, right? Like the Fed has basically committed to maintaining 0% interest rates forever. When did that happen for the first time? That happened for the first time during the Great Recession in 2008. Right? And they barely went up, and as soon as they started going up, it almost threw us into a recession, right?
Right.
So the game has changed. We're kind of entering this period of there's this concept called modern monetary theory. You know anything about MMT?
No, I actually don't.
So it's like when we can't manipulate interest rates any longer, we're just going to create money, right? Right now, you've got the Treasury doing it, but I think this relates more to the Fed creating money, which I don't believe they're able to do as of now. So I mean, we're kind of in that situation, and you're right. I mean, from 1928 to 1950, there's a reason these different sources we're looking up are starting on different years, right? Like, oh, hey, it looks good if we start from 1928, or it looks bad, right? But I agree, man. Like, as I'm looking, you know what? I'm totally switching gears here, and I don't want to forget this because I just thought about it. I mentioned that book that I read to you, Unknown Market Wizards. That was you. I was talking about that.
I don't think so.
Okay, never mind. Never mind. Psych.
We can talk about it right now.
So I read this book, probably like end of summer, beginning of fall when it was released. I don't remember. Maybe September, October, the book came out. It's about these individual traders. They're not managing client money where they actually have some responsibility with regards to making sure they don't lose 100%.
Right.
Right. So they can get pretty risky. They can make concentrated bets. And I read the book because it's basically like a dozen stories of people who took, give or take, let's say $100,000 and turned it into 10 plus million. Like, that's interesting. I want to learn about that. One of my biggest takeaways is they all got lucky. Every single one of them got lucky. They had concentrated bets on tiny little micro cap stocks that 100x'd for them. The one guy he ended up on the board of the company because he owned such a high percentage of the shares of like $100 million company, right? Pretty wild stuff. But the other thing I noticed, D, is every single one of them that had a trading system that worked, their trading system eventually went obsolete.
Right.
Because other people figured out about it, started using it, technology changed. So in reading that book, those were kind of my two big takeaways. The game changes, and I agree. I don't think we should really be looking at extrapolating trends from pre-2000.
I totally agree. And, I think that was my main takeaway in preparing for the show is that, things are just so vastly different now from the number of people who can place a trade.
Yeah.
I mean, how many people could actually on their own place a trade let's say we're in high school, 1995.
You'd have to call a stockbroker.
Right.
Who'd take a big commission to do it.
Yeah.
Yeah.
How much did that person make just for taking that call?
Yeah.
What, probably
I don't know.
6%?
Probably.
Yeah.
Yeah.
So it's just such a different world now. And what it made me think of, the yield curve inversion.
Yeah.
Basically, if the yield curve inverted, that was basically going to be the end of humanity as we knew it.
Yeah.
Right.
Straight into a recession.
Exactly.
Yep.
So, I mean, these things change over time. And the major difference there was, when did that ever happen when interest rates were near zero?
Yeah.
Never. Interest rates have never been at these levels. And it's just a totally different game.
Yeah. Now, it's also very dangerous to take kind of the devil's advocate position here. Yep. It's also, and I'm taking the devil's advocate position against myself too, but it's very dangerous to think this time is different. That's when you get blindsided, right? Like, history may not repeat itself, but it tends to rhyme. Mm-hmm. That's another one I just thought of on my toes.
That's awesome.
You like that one, huh? But again, man, like, I don't think anything pre-2000 is that relevant today, Mm-hmm. I mean, just look at the differences in numbers we just arrived at between me starting in 1950 and you starting in 1928. Right? You had January as the best performing month. I start, 20 years late after you, and January was the 5th best month. Mm-hmm. Like, that's huge, man. So, and that goes back to the last show we did. Like, watch what you read, right?
Yeah, for sure.
Like, you need to make sure that just because you read something doesn't necessarily make it true. Like, you should probably check out that math across different time horizons,
right.
But look, man, is this time different? I don't know. I think innovation and technology changes, frictionless ways for retail investors to buy and sell fractions of a stock,
mm-hmm.
Fractions of a share of a stock. It has changed the game. The game has changed. And when the game has changed, I think you need to, look, dude, we just experienced the worst recession since the Great Depression in 2020. Mm-hmm. And the market was up. It was up like 16, 17%, dude. Like, will we ever see a negative year again? Or does the Fed have our back? Does the Treasury have our back? Like, I don't know, man. Like, you used to see, just look at the tech bubble, right? I mean, the early 2000s, we had 2 or 3 consecutive negative years. I don't remember off the top of my head without having it in front of me. But I thought 2000, 2001, 2002 may have all been negative or pretty darn close, right? Now, if you see one negative year, that's crazy.
Oh, yeah.
So I mean, let's get back on track with this January effect thing. Like, do you buy into any of this stuff?
So I don't, and really, I kind of analyze the last 2 years, because really before 2020, really the most distressed I can remember the market being was around Christmas time, kind of October to Christmas time in 2018. So the end of the year, 2018. I believe that quarter ended up down around 8 or 9%.
Yeah.
And, magically in January, it was up about 8% in January 2019. And because the market was down big at the end of 18, that momentum in 19 carried forward through, and we had a big year in 2019.
Yeah.
Now, the start of 2020, January was basically flat.
Mm-hmm.
And I remember thinking in January, from a show we almost did, I remember thinking in January, what is going to stop this?
Yeah.
Like, I couldn't come up with a single
ding, ding, ding. I can give you an answer.
Global pandemic stopped it.
Which stopped it temporarily, and then it resumed its upward rise, right?
Yeah, incredible. So while there may have been something to it, frankly, pre-2000, I don't think there's a whole lot to it right now. I think it has a lot to do with kind of the momentum. I'm a big believer in momentum and kind of what is left over from the year before and how you can calculate that into the expectations for the upcoming year.
Yeah, the other thing I heard people talking about is January tends to be a good month, which, again, by my analysis, it was the 5th best performing month, so I wouldn't run up and down the streets talking, screaming at the top of my lungs about how great January typically is. But the other thing I heard is it's like an investor psychology kind of thing where people make a New Year's resolution to save more money or buy more stocks. Whatever, I don't know. I don't know if I really agree with that.
Mm-hmm. It's kind of a mass generalization, right? It does make sense, intuitively, but is that really moving the market more than it normally would in a given month?
Yeah.
It's really hard to say, in my opinion. And
are those really meaningful dollars, dude?
Right.
Somebody, the retail investor who decides that he or she is going to save an extra $100 a month, do they move the market? I'm going to say no.
I don't think so.
They don't. Institutions selling reallocating money from bonds into equities, that moves the market. Mm-hmm. It's institutional moves that move the market. I don't know, man. I don't think retail investors making a New Year's resolution to save, an extra $100 a month is market moving.
Right.
Even if a bunch, half the working population decided to do it, I still don't think it would be market moving.
No, I totally agree. Totally agree. And, I think, what did you say? History doesn't repeat itself, but it rhymes.
Yeah, you like that.
I've never even heard that before. That's amazing.
Yeah, I've only heard it once. Somehow, some way, I filed that bad boy away to be used in the future, and it was used today.
That one. So, I think kind of use things like that as guides, right? Just another data point in making your overall decision, right? We just did our last show about kind of the 10 steps that you can do to be make your finances financially fit.
Yep.
Use these little things as kind of a data point to help you make decisions.
Yeah.
But in my opinion, I don't know if it's going to really persuade you or dissuade you from making an investment in January.
Yeah.
Make sure it fits your plan. Make sure it fits your risk tolerance, and monitor it. Right. That's the most important thing. The conditions in the market change almost daily now, and that is something that it is much more pronounced than even when I started in this business.
Yep.
So you have to be on top of these things, and you have to pay attention.
Okay. All right, we're going to wrap up the show with this. It's always foolish to make a market prediction, but we're going to do it anyways. All right. So I'm going to bet, you were going to bet 90 minutes at Top Golf.
Okay.
Okay. And we're going to see who's right come December 31st, January 1st of next year. And this time next year, one of us is going to be paying for the other guy to golf. Okay. Let's say the stock market. What's a reasonable rate of return? High single digits. Let's go 8.5%. You want to take the over under for 2021?
Well, if you're going to give me the choice,
I'm going to give you the choice.
I'm going to take the under.
You're going to take, ooh, I get my over that I was looking for. All
Are you
right.
taking the over?
I'm going to take the over.
All right.
All right, so we're going to go, I'm going to take the over. You're going to take the under. Let's write this one down. We are betting on 8.5%. That is the total. Mark has the over, Derek has the under. We will see who will be paying for Topgolf next year. That wraps up today's show, folks. Thanks for joining us. Check out the show notes on the website. Check out the YouTube channel. Make sure you subscribe to our podcast so that you're getting it every single week. For those of you who are new listeners, we appreciate it. We try to release a podcast every Wednesday morning. Sometimes Apple likes to drag their feet, and it may not hit until 11 a.m., 12 p.m. Eastern time, but nonetheless, they are typically published at midnight on Wednesday morning. So we appreciate you listening, and we will talk to you next week.